It's now official. Interest rates are definitely over 4% in the mid fours as of right now. And with the meeting that happened on March 15th, odds are rates are going to stay high for the foreseeable future. You may be wondering, as a first-time home buyer or just a general home buyer, what do I do now? This is a very crappy situation. And in today's video, I'm going to just help explain my thoughts on this, and maybe it'll help you make your decision now if you want to still buy or if you decide to wait. So first and foremost, the first thing I want to do with this video is I want to acknowledge your feelings. This is a very, very crappy feeling to have. Your brain likes to go, well, if I would have just bought 2 years ago or a year ago, I would have gotten a 2.8 interest, or I got a 2.5, I would have gotten 3.3, and you start self-sabotaging and really making yourself feel like crap. First, I want to acknowledge that your feelings are valid. This is a very crappy situation, and it's very frustrating. Even me right now, I'm currently closing on my house in the next few weeks, and it unfortunately looks like I'm gonna be stuck with the higher rate. It is what it is. But remember, the first thing that we always have to address is that you buy when your finances are ready, not when the market has the best interest rate or the best terms. What do I mean by that? Well, let's get into the numbers here, shall we? So first and foremost, I decided to pull up some interest rates here in my specific area. Here in Arizona for a $400,000 house with a 10% down, 30-year mortgage, and average interest rates that we're seeing is 4.375. Funny story is I actually had a client that came into town and they went looking at a bunch of houses with my showing agent. When it was time to make an offer, they started panicking. They said, oh my gosh, we don't want to get stuck with this interest rate. I think they were being quoted 4.2 or something like that. And they were wanting to shop around. They just felt like it was too high. And in their case, they actually had a credit score range a lot higher. So they were like around like 800, I think. So they felt like they should be getting a lot. Even at 800, 799 and up, you're still going to be in the fours according to this, and it seems to be pretty accurate. So there's a lot of people now that are starting to get really spooked by it. But just so you know, that's the interest rate, at least that I'm seeing here. You can always go here. It says consumerfinance.gov/owning a house, or you just do what I do is look up CFPB interest rate, and that's where you can find this. Of course, nothing's perfect. The best thing you can do is talk to a mortgage broker or mortgage banker, and they're going to be able to give you a better idea without pulling your credit. They can just know because they're always looking into the rates and whatnot. So yeah, interest rates are going to remain high, but let's talk about what the effect of this means. Because remember, I told you your priority shouldn't be I should be buying when the interest rates are the best or when the market's the best. Your priority should be I'm going to buy when I'm ready, when my finances make ready. And this is what we do first to establish that. Let's say you're buying a $400,000 house with 10% down, and your interest rate would have been 3.75 with the property taxes of $2,200 and home insurance of $1,200, and we're including PMI and whatnot. That payment would be $2,127. If this interest rate goes up to 4.25, that goes up to $2,231. It's approximately $104 dollars. So how many tacos will that buy? I don't know. Let's say a good taco is probably like what, $3.75. Let's say $4 with tax. That's a 26 tacos. That is a good time. 26 taco difference for an interest rate of 0.25. Now, of course, I don't want to minimize, it's only $104, because the true effect of this is actually we can find this in the amortization schedule. I'm not recording this days later. I don't know what you're talking about. Anywho, let's fix the calculator to show where it goes. And just to kind of compare numbers, this calculator is telling me 109 is the difference between 3.7 and 4.25. So kind of show you how it works. So this website's gone really butt since I've last used it. Like, they're trying to sell me a bunch of crap now, which I don't like. But anywho, here's the true difference that we see with the amortization. Okay, with a 4.25 interest rate, we're gonna pay a total of $292,000 of difference. This website's gotten really bad since I've last used it. They have all these like features now, and I don't know, they're trying to, I guess they sold out, so boo-hoo, shame on you. But anyways, with 4.25, we can compare with 3.75 the total amount of interest we pay after 30 years. And basically for 4.25, you pay $292,974 of interest, and you pay $253,542 of interest. So about $39,432,000 difference. Not bad, but let's face it, not everybody's going to live in their house for 30 years. They're maybe going to live about 10 years. So what we can do is we can actually go 2032 of March and see what our amount's going to be due there. With 4.25 interest in March 2032, we're going to owe a balance of $301,084. $301,084. And with 3.75 interest, we're going to owe $295,992. So that's a grand total difference of, let's account the true damage here, okay? Because let's say down the road, you are in a position where you instead of buying, you decide to rent for 10 years, okay? There's some pros and cons to consider here. One, the biggest pro is you're going to save yourself from any potential market shifts that may happen. And according to the YouTubers out here making videos, market crashes happening once a week. So you're going to save yourself from all these market crashes. While they continue to consult investors on where to buy, they're going to continue to scare us with market crash videos. Sorry, yes, am I salty about that? Yes, I am very salty about that. But you're going to protect yourself from any potential damages that might happen for the market shifts. Biggest con I see personally is you think you're not really saving much money, because let's face it, rents are going up at an enormous rate. They're actually going up probably higher than monthly payments are for mortgages. Right now, if you want to rent a decent place here in Phoenix, it's no longer like cheap old $1,200-$1,300, and it costs you at least $2,000 and up, maybe $1,800, $1,700 if you get lucky. So let's say you do spend, $2,000 for rent. You multiply that by 12. About to have 10 years, you're going to pay a total of $240,000 in rent over the span of 10 years. And that money goes nowhere. It goes absolutely nowhere. Well, actually, it doesn't go nowhere. It's going to paying your landlord, which if things continue to go the way they are, will probably be a corporation of some sorts that decided to buy during this time. Or that are being consulted to buy by these market crash YouTubers. So you're probably going to pay some landlord's mortgage, or they're going to make them money in some way. Okay. While you're being concerned, you may potentially lose $240,000 over a span of 10 years because you decided to rent. So I wasn't okay with the way my argument was going, because I felt like I needed to show more validation in numbers here, because I know I got a lot of people out there that are very number focused. So here's what I did, okay, just to kind of help the argument a little more. I created this spreadsheet, just really quick, just right now, to kind of show the differences between two options. Because in option A, you rent for $2,000 a month. And we can kind of break down here the cost it will take after 10 years, right? So this is its own little separate category. We'll put that, let's just call that, let's just say that's separate, okay? So after 1 month, this is yearly after a decade. So if they're both $2,000, which is $2,000 is the average payment I'm seeing nowadays, even with the high interest rates. And a lot of people are crying because this should have been $1,900, because if the interest rates would have been cheaper at $1,900, that would have been, if the interest rates were cheaper, that would have been closer to $1,800 or $1,900, and the balance after would have been like $3,000 cheaper, right? So we're not talking about that right now. We're kind of comparing both. High interest rate, monthly payment, $2,000 for a $400K home, and $2,000 monthly rent, okay? Both of them after a decade are going to spend about $240. However, to purchase a house, you're going to need more initial cost. You're going to need at least, I put 5%, and I put here's the numbers here. I did a purchase price, here's 5%, and here's 2% to calculate closing cost. So 5%, 2% of closing costs, and I added about $10,000 of repairs over a lifetime. I'm calculating about $1,000 of repair every year. I've owned a home, that's about it, unless you had some bad luck and you got to replace your AC or whatever. So I can bump that up to 20K if just to be super cautious. So yes, after a decade, you have spent more money owning a house than renting a house. So you are technically saving money renting a house. So now, if you remember, we found out that our balance for 4.25 interest rate was $301,084. That would be the total balance after 10 years. There is the main difference here. So a lot of people out there think that the market's going to lose its value and this is going to be a massive crash. I think it is unwise to assume we're going to continue to go up at 20% per year. I agree with that, but it's also unwise to think that we're going to have this massive crash that everyone's just going to lose all this value. I think there's too much money tied into things, and if that's the case scenario, then you shouldn't be watching this video. You should go be watching those other people talking about market crashes, right? So let's just assume worst case scenario, values stop going up. Or maybe they go up over the next few years and then they went back down and you're about the same where you bought it. So let's assume a few things. Let's just go best case scenario that you actually made some money. No, that would be worst case scenario is it's selling less than what you bought it for, and middle case scenario is you're selling it for the same price you bought it. Okay, so we'll put our total balance here. Let's do our best case scenario. Let's say your house goes up 5% every year, which is generous, but let's assume. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. For some of you guys, that might be wishful thinking. So let's just say $600,000 since you guys don't like seeing good news. $600,000. So we can do a quick little formula here to essentially, actually, let's be even more creative here, and let's multiply after commissions and after title fees. So let's just assume 0.95, so 5% of fees and commission, which is yeah, that's about usual. Best case scenario, which once again, it was like closer to 650 when, what was it? 651. So let's say 5% per year continues to go up. You made some money. Okay. Yeah, technically, if you look at what you actually spent, that repair number is a little high in my opinion. But anywho, you know, yeah, you made some money. Now, worst case scenario, you sell it at the same exact price you bought it for. After 10 years of paying $303,000, you're leaving with $78,916. And yes, if you would have rented, you would have spent a total of $270, but you're walking away with less. And if you want to be really analytical, we can remove those $30,000 from here. You're still walking away with $45,000. If it went down $50,000, you spent $33,000 more, but you're still walking away with something. So in that case, probably not worth to sell it. Probably hold on to it and turn it into a rental. Go rent if you have to, but turn it into a rental or just continue to live in it longer. First off, I want to address the common thing people have now is, because there's obviously two sides of this on YouTube. People believe that everything's gonna crash, and then there's people that believe that everything's fine. And then there are those who are just trying to educate. And if you're on one side, you're a real estate agent, or you're a lender, or of course you're telling people this. It's your business to do that. And then the people that on their other side don't really get criticized because they're just kind of, or at least I don't see the criticism. They certainly are respected by their peers, but they seem to be feeding into this narrative, and people don't hold them accountable. They just kind of spout this nonsense as it comes on the news. Like there was one the other day where Putin was causing the market crash, and they just move on to the next headline, and they're not held accountable for their actions. So listen, whatever, I am on this side. I am on the side of being cautious, of focusing on yourself, making sure we're not focused on the market, but focus on when you're ready to buy. And when you buy, make sure your budget makes sense. And yeah, things might go great. Things might not go great. Whatever happens, you're secure to your house. You can afford your monthly payment and you're solid. If things go great, you can thank me because you're going to make a bunch of money. All that to say, guys, regardless of what happens with the interest rate, they may go up, they may go down. You always want to focus internally and buy what makes sense for your budget. I know that's a typical thing to say. Oh man, I want to make some money. Listen, buying a home is about securing your legacy, securing where you're going to be, making sure you own where you live. It's not, yeah, you can make some money potentially, but let's not be Warren Buffett for the next 5 or 10 years. Market's a little unstable. Secure your bag, secure your house, forget about the noise what people are saying out there, and then get your place. Because at the end of the day, if things go up and great, yay, you're going to thank everybody. You're going to thank me for saying, oh, I've already made me all this money. If things don't go great, you know what? You can still thank me because you have a place that's secure for your family. You have a place that you can be able to afford. And guess what? If you hold on to it long enough, odds are you will eventually get back to the point where you can sell it and make some money on it. Okay? So take a deep breath, relax. Everything's going to be okay.